For Wall Street Media, this is Marley. I'm here with Doug, and we'll help you make money in the stock market with information you can't get anywhere else.
And guys, we've got a good expert, Rich Gordon, fixed income strategist at Wachovia, who really is wired in and spends all his time and effort in this particular area, giving his thoughts on the Fed's recent actions, right?
We have about 6 minutes of thoughts today.
Well, here you go.
As Doug said, we have Wachovia Securities fixed income market strategist Rich Gordon, and he discusses the initial impact of last week's Fed action on the financial markets. Here it is.
Hi, and welcome again to Market Summary Online. The Fed's decision last week to throw an enormous amount of liquidity at the financial complex has finally caught investors' attention. Credit shorts have had to reassess their commitment to continuing to pay huge premiums for protection against credit failures for extended periods of time. While a lot of things about the duration and severity of this credit and economic downturn remain uncertain, the Fed's decisive action last week appears to have pretty much eliminated the risk of defaults in major bank and brokerage names. In watching market movements for the last 5 days, we can make several points. First, in equities. The U.S. equity markets appear to have reversed. The chart shows the weekly price action of the S&P since the beginning of 2005. The bear trend that's been in place over the past 6 months came to a conclusion, at least temporarily. The chart shows that Thursday's close on the S&P at 1330 was a reversal of the downtrend, and so far this week there's been follow-through interest in equities worldwide. The S&P closed on Monday at 1350, up over 4% from last Wednesday's close. Second, synthetic corporate credit spreads have tightened very sharply as credit shorts have been forced to cover and opportunistic traders scramble to get long. The chart shows that synthetic IG spreads have tightened 45 basis points since last Monday. But cash corporate spreads haven't participated to nearly the same degree. The basis between the indices of cash and synthetic spreads has widened by 40 basis points since the Fed announcement. Cash spreads have lagged due to the heavy potential new issue pipeline. Investors have come to expect large discounts on new issues, and while those discounts will probably get smaller because of the better market tone, investors will still expect to benefit from concessions. Dealers still want to keep inventories low and risk off their books. If it wasn't obvious before, it should be clear now that synthetics are generally not a viable market value hedge for cash securities. They're really only a viable hedge for default. Last week's price action just provides another example of the lack of correlation between the two products. Another area that's benefited from the Fed's actions is structured products. With a lot of the near-term liquidity issues taken off the table, structured product spreads, especially in the highest rated tranches, have tightened sharply. This makes sense because a substantial portion of the extremely wide spreads in structured products with the highest ratings was from a big liquidity premium. This premium increased with the pressures in the financing markets and with the need for financials to decrease their balance sheet exposures and deleverage. Up until last week, the series of rate cuts and fiscal stimulus had failed to generate a lot of risk-taking activity in spread products. It's still not clear to me that investors are very comfortable adding a lot of spread risk right now, but it does seem that they're more reluctant to be outright short. Some investors have been adding assets selectively at very cheap levels, and as spreads begin to contract, more might do the same so they aren't underinvested in a big rally. The table shows CMBS spreads over the course of the past week. We calculated the basis points of tightening and also the percentage of spread tightening. The Fed's liquidity measures look like they've had a positive effect across the board, but especially in the highest rated tranches. AAA CMBS tightened by 22% of its available spread compared to 11% for BBB tranches. The Fed's decision to allow dealers access to the discount window was a substantial benefit for spread products. For dealers, access to the Fed window gives them more favorable financing rates than are currently available from repo lenders. They now have the option to hold the securities, finance them, and wait for a better exit point later in the year. One reason for the better tone for risk products is that short-term Treasury yields had reached levels that almost required investors to try and take some measured risk. Look at the chart of yields on one-month bills. As investors fled risk assets over the past couple of weeks, the one-month yield touched a low of 26 basis points on March 19th. As repo lines were pulled and risk was reduced almost without regard to return, money flooded into the Treasury market, especially on the front end. But a lot of investors aren't going to be satisfied with returns that low over an extended period of time. The cost of staying in cash is very high right now. So any significant improvement in sentiment was almost certainly going to force investors to sort through some of the bargain basement prices across a wide range of asset classes and begin to test the waters. Leveraged loans participated in the credit rally, with LCDX almost a point higher on Monday, and cash loans also had strong customer interest. I still wonder whether rallies in this sector can be sustained over the long term, with both the prospect for heavy issuance at significant discounts and an inevitable increase in the default rates. But the ability of dealers to get financing on their leveraged loan positions has to be considered a very positive development, and it should help to limit what potentially may have been more deleveraging in that sector.